Well, hello there, and thanks for joining me. My name is Joe Jensen. I represent Maverick Trading, and I want to talk a bit about why most traders fail. Did you know that over 70% of traders lose their money? I've been doing this for 25 years, folks, and yes, I am part of that statistic. In my earlier career, I found success early before I even knew what I was doing and ended up driving my account to zero.
Attention! This video is for informational purposes only. Maverick Trading is a US-based prop firm that specializes in option and equity trading. If you want to become a professional trader for a firm that backs you with capital, apply now.
It had nothing to do with the markets. Nothing was rigged. I didn't have bad luck. My strategy was pretty sound. The painful truth was it came down to who I am and what I didn't prepare for. I want to talk about the two biggest mistakes that I found unsuccessful traders make. Not having a detailed plan and complete disregard to risk, or not understanding the true risk of the positions and the style of trading they've been making. These are the two things that should be jumping out whether you're brand new to trading or you've been trading for quite some time. So let's talk about the dangers of trading without a detailed plan. The structure will become inconsistent. The only thing that we can control is how we enter the markets, enter and exit the markets. Scanning, a consistent way of scanning and looking for opportunities based on a consistent pattern. If we are just pulling things at random, we can't expect to find something consistent when it comes to stock pattern development or behavior. Triggers, how we enter, when we enter, how we exit, how do we gauge targets, all has to be based on a consistent system. A big part of this is going to be management. When do you adjust? How do you adjust? Why do you adjust? Your timing will be consistent also based on what you see in front of you. Another pitfall goes into the psychology part of things where it becomes hindsight. What you see in hindsight changes what we're going to do in the future. If I would have just held this a little longer, or if I didn't get out too early, things like that. This leads us to become susceptible to emotional actions, cutting winners, holding losers, over trading, revenge trading. Another one is flip-flop trading. I've seen traders buy a stock, it goes against them, so they turn around and short the stock, and it goes against them. Shorter term becoming longer term, and vice versa. I just want to get into the stock for a few days, that turns into a few weeks, and it turns into a few months, usually because the stock's going against you. I also have traders that have a position that's working out for them, and they take it off in 3 days versus the 2 months they wanted to keep it. This also applies when following trade alerts and or someone else's strategy. Folks, there's a lot of great strategies out there that we like to follow, and there's a lot of great traders that post their trades online. The responsibility will always be ours. Remember that, it's yours. You're going to make the trade, you have to manage the trade, and you will be responsible for the outcome. Some strategies out there can need higher levels of capital or higher frequency to be successful. Understand, if you're following a trader that has a $200,000 account and he's making trades that might leverage that account and you've got 10,000, you might not be able to keep up or follow it trade for trade. Let's move on to the second part of this, understanding true risk. A lot of beginning traders don't really understand the positions that they have or how exposed they are at the market at any given time. Know the total dollar amount used for the position, including margin obligations. If you buy 100 shares of a $25 stock, understand that that is the amount that's going to be pulled and held into your account until that position is closed. If you're using stop losses or some sort of a management system, that does not take into account the amount of money held for the position. Be aware of how many positions that you have at any given time. This is referred to as portfolio exposure. If I've got 1, 2, 3, 4, 5 trades on, I might have every single dime of my smaller account out there at risk at that time. Position size equally according to cost, not share amount. I know this is a rookie mistake, but it can get away from us pretty quickly. If I've got 100 shares of a $20 stock and 100 shares of a $300 stock, there is a vast difference in the amount of money used for those positions and the amount at risk. Directional and sector exposure. We talk a lot about a portfolio balancing here at Maverick. So when it comes to everything is in one sector, everything is all bullish, that leaves you susceptible to a market correction in a sector that could really have a major impact on your account. Make sure you have that balance, or at least you're aware of it. Let's move over to the management part of understanding true risk. Stop losses are a great thing to have. However, they do not guarantee or lock in risk, meaning you are going to be fully on margin or responsible for the position of that stock, regardless of where your stop loss is placed. So don't think that you can buy a $100 stock and put a $5 stop loss on it, thinking that you're only responsible for that $5. The money that is out of your account to hold that position is 100% the value of the stock at that time. Probability versus profitability. I run into this a lot. Here's some really great trading strategies. 0 DTE, iron condors, cash secured puts, also known as wheel strategies. These are wonderful, but understand that they're a higher probability trade, which means the reward is smaller than the overall risk. Understand that when you do lose in these trades, you can lose a lot more than you think. Fixated on dollar amount over a percent. I call this greed. And most traders, when they get into trading, they, like myself when I was younger, I wanted to take my first $15,000 account and turn it into $1 million. So I would take a look and follow some traders that are trading with $500,000, $250,000, $300,000. Their style is a lot different than what I could do with my smaller account. So don't be fixated on making that $500 or $1,000. You need to fixate on the percentage gain based on your account. This will also help you when it comes to proper position sizing. Folks, I can go on, but I think the two biggest takeaways for this short video were understand that you have to have a plan that you can follow to build that consistency, and make sure you understand the true cost and risk when it comes to your exposure. Trading takes discipline. It should be created based on individual circumstances. When I first started, I was trying to trade like a millionaire, even though I was a 21-year-old kid with 10, 15 grand. Knowing true risk and exposure at all times is imperative. Now, you have to survive first before you can be successful. Too often do I see traders make one or two mistakes, but since they were over leveraged, it wiped them out. We want to make sure that we can live to trade another day. It's not about making that dollar amount. It's about to stay consistent and build that percentage by percentage. You will eventually get to those larger accounts, and those percentages will just result in larger dollar amounts. Now, there are a whole bunch of other things that we can elaborate on and fine tune, but those are the two biggest takeaways over my 25 years working with traders that I've noticed being kind of the straw that broke the camel's back. Thanks for joining me, folks. I hope this was helpful. Talk to you next time.
Maverick Trading releases daily videos on market commentary and potential trades. Check out our latest